Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, Chris Galipeau, Senior Market Strategist at Franklin Templeton Institute, and Bruce Pringle, Head of Education at Bookmap. We're here to discuss broadening and stock performance and how global market structures are strengthening and expanding, offering a broader investor base access to the markets. It's great to have everyone with us on Fed Day. Another decision came through.
Yeah.
And Chris, really, the story has been that the market is starting to broaden out, and it's not just the Mag 7 story.
Yeah, right. So we've been talking a lot about that. We've really started to notice that probably last July or August, and that there was broadening participation in terms of price, but we really hadn't seen it in terms of fundamentals, i.e. earnings. We did a lot more work on that because it occurred to me that what I was watching in the third and fourth quarter of last year was probably a message the market was sending me, like, hey, there are other pockets of value and earnings growth that are probably coming online. When we actually did the work on that, that was the case. And so we've gone from a tape where from 2020 to 2025, it was all Mag 7 all day, right? If you look at the cumulative earnings power of those names in that 5-year window, the earnings growth was up 750%. The stocks were up 650%. The S&P was up 100% with 30% earnings growth. And so that's why those stocks led. They should. That's how it works. Slowly and quietly, the earnings power has gotten broader here. Looks very good for 2025. Looks good for calendar 26. And so we really leaned hard on that coming into the year, telling our clients, Mag 7, we're still constructive there. We like those names, but there are other names that you should consider as well. And that wasn't just true in the US, that was true around the world, right? True in Europe, true in EM. And so that's been the stance all year, and for the most part, that's worked out very well.
Yeah, and you know what's interesting, Bruce, is the contribution that retail traders have had to the broader markets as well, with market structure evolving, with it expanding, offering retail traders access to markets. You know, Chris was on the floor, I was on a desk. We didn't even have some of these tools.
Yeah, no, it's great. I mean, you have access to all these tools, and the technology has obviously allowed it. So it's on kind of toe-to-toe in some cases with some of the professionals out there. The speed, the software, the computing power, all meshes really nicely for the retail trader to act very nimbly with small size.
Do you think that we're in the golden era of retail trader sophistication?
I think so. I mean, we're seeing products out there that are unique, look at the market in a different way, and that offers an edge that wasn't there before.
Yeah. So we got our rate cut. The market was broadly expecting. Anything out of that? I know it's still there's comments still going on out there. Anything you could discern?
Well, I think one of the things that jumped out immediately, obviously I haven't seen the press conference since that's happening as we are speaking, but the 2 dissents, one for 50 basis points, one for no cut, and you've been hearing kind of murmuring that not everyone on the FOMC is so convinced that inflation's something we can kind of look past. And so this is maybe our first hint that we're getting some people starting to push back on that. It'll be interesting to see come December and the months after if we start to see maybe more people piling onto the no cut kind of bandwagon, and if Powell can kind of keep everyone going the same direction or not. If it's really inflation remains a kind of clear and present danger for a significant number of people on the Fed.
I would imagine employment is going to be a key issue that they're looking at as well. I mean, certainly the headlines were reflective of that this week.
Yeah, definitely. They specifically said that a big reason why for this cut was downside risks to inflation have increased in the last few months. So, which seems consistent with the data, but it's just, you have to decide who on the Fed is going to go each direction, and there's still some that are quite worried about inflation, even though if you look at the tariff-related inflation, we saw some of that with CPI on Friday, where clothing and furniture and personal goods came in a bit hotter than some other goods categories, but we're still seeing housing inflation slowing down. The rest of services, it looks like wage growth is going to continue to slow, which should put downward pressure on services. So really outside of the really tariff-exposed goods, there's a lot of disinflation still to come. So to me, it seems like let's focus on the employment side, but I'm not on the Fed.
Well, Chris, I mean, the market and economy are two different animals at the end of the day, but continuing to all-time highs. So it's climbing the wall of worry as it has been all year.
There's a lot to unpack here, right? So the S&P itself has made something like 30 new highs this year. And another new high today prior to the announcement. The rest of the indices continue to move higher. The Dow, other smaller cap indices are also moving higher. Different catalysts across the board, but if you look at, say, like biotech, they've been on a run since the Trump RX announcement with Pfizer, and a lot of M&A into the space, which is good for capital deployment as well. So that tells you that investors are confident in the areas that they're investing in. To your point, Chris, before, it is a little bit of a broadening that we've been seeing across the board, but for different reasons. But there's still a lot of concern, right? On the Fed side of it, I think you've only got 4 more meetings with Powell at the chair, and really not sure what's going to happen after that and how that goes down. So that could be very interesting for the rest of next year and how this works out. So once we start getting data back from the government, especially on official employment data and some of the other PPI, I'd love to take a look at all of this. We don't know the impact of what the tariff situation is going to have in Q4. Spending is going to be a major concern for the consumers here. We're just starting to see a lot of the companies with earnings come out for Q3, and it is a concern. Some of the forecasts from NRF and Dana Tesley's firm are very wide in their predictions of what Christmas spend is going to be. Right? Because you don't know the impact of tariffs, the cost, and how much the consumer can shoulder. Lower income continues to be suffering here, trading down. Employment wages, which you just mentioned, lower income right now is below 1%, which is one of the worst year-over-year increases since 2019, while higher income earners are at the higher end, north of 3%, and they'll continue to spend on luxury and services because of the wealth effect.
I also think it matters how they are spending, which brings me to the question of credit. How would you interpret it? Because we heard a couple of canary in the coal mine adages.
Yeah, and so our view is those probably aren't canaries in the coal mine. To your point, Chris, if we back up and go back 2 weeks ago, and we think about what the big banks told us they kicked earnings season off. Here's the picture they painted: resilient economy, resilient consumer, right? Earnings were great. To your point, their capital markets business was outstanding. More than one bank told us in the quarter that their loan books, the quality of their loan books, NCOs and delinquencies, improved sequentially from Q2 to Q3. So there's a bifurcation, as you point out, right? But it looks like there's not a lot to be worried about, knock on wood. The loan situation that we saw kind of cluster together seemed to us to be a combo of maybe not a great market in terms of subprime auto lending, right? And then what sounds like some fraud, right, for the West Coast banks. We don't think those are harbingers of bad news to come. I think the big banks told us that in earnings season. The other thing too is we would have seen wider movements in IG and definitely high yield spreads if we thought that was a contagion. We really didn't get that. So I think the backdrop is constructive here.
It makes you wonder if some of the wealth effect for the consumer has been through retail trading, right? I mean, because you have it noted here: online communities, events, easily sharing and gaining knowledge, and the education component as well.
Right.
We saw that through COVID especially, and I think that's one of the reasons why you're continuing to see retail participation. There was a lot of wealth that was created there.
Yeah, absolutely. At this point, though, I think we're kind of at an inflection point, and we continue to go to all-time highs, as you were saying, which is dizzying. We had a technical breakout that a lot of retail traders really like the technicals. We look at that from Friday. We had that breakout last Friday, and it's in nothing but upside since. So where are we going? Will there be, how are the earnings going to be coming out? What's going to come out of the trade talks and the FOMC as well?
I have a question to you, though. What about more access to liquidity and leverage, right? And they have more, retail traders have it more than they ever had before. What are your thoughts around that? Because sometimes you don't necessarily understand how to use both of those concepts. Have you seen any impact on the platform, or just what you're hearing from traders?
Oh, sure. I mean, that's a double-edged sword. I mean, it can be fantastic, and it can really be harmful if you don't know how to use leverage.
Yeah. I mean, we hear about these levered ETFs, many of which we list, and sometimes, even in Europe, you can get way more leverage than you can get here in the U.S. And I'm curious.
The OMC sets the margin percentage of 50%, right? And so most of the banks put it down a little bit less. I'm not sure what you do on your platform.
Yeah.
But the more leverage you are, and if you're wrong, you go home and you move back into your mom's basement.
Tell the traders stop loss, good till canceled. Right?
Yeah.
Yeah, pretty much.
Yeah.
Yeah, but it's just I just find that so interesting with all the robust programs that are out there now. Are you seeing that on your platform where you're using alternative ways to get exposure to the market relative than just equity investments?
Yeah, I mean, I think just this is where education really comes in, of like trying to get across the point of these are highly leveraged products in some cases, and be careful because the downside could be very, very quick.
Yeah, well, it certainly can. And Chris, from
Reminds me of the SKF bet way back in the day.
yes, in 08 and 09, but what is the escalator up, elevator down, and
Crowded trade,
Yeah.
right? When it unwinds very quickly.
Yeah.
And it's not always works very well.
I use that line all the time.
Yeah.
Stocks take the staircase up and the elevator down.
But what's interesting, though, we're having a conversation that sounds robust going into 2026, but for over the past couple of weeks, it's been, are we at an inflection point? Do we have to start questioning IT spend and so forth? And the narrative has changed quickly. A lot of these themes, any number of them, could be its own story over the course of a few months, and it's, it's intercession now.
When you have a lack of economic data and you're relying on other sources, whether ADP, which is generally reliable, and consumers and surveys and other items, what are you stuck with? You're stuck with the earnings reports and how, to your point before, how the banks came out with saying, consumer is actually doing well.
Yep.
Now we're starting to see some of the consumer names come out, and it's hit or miss depending. There's a lot of concern in the restaurant space, especially larger companies. Some of the smaller ones are doing okay, but getting hit. Staples continues to trade down, right? You're seeing product sizes change. Retail will start to come in a few weeks. We'll see what they have to say for the most part. It's going to be it's going to be very interesting how this works out. Yes, we're set up very well across the board for large cap growth. AI spend is tremendous. That's going to be a driver. And the large cap companies have the earnings power to continue to drive that. $5 trillion companies, $4 trillion companies, right?
A lot of free cash.
There's a lot of free cash.
A lot of free cash.
There's a lot of free cash out there, but Michael, the contribution that tech spend has had to GDP, it could be a blessing and a curse as well, because you need that spend to stay either static or continue to rise in the absence of a consumer that's spending.
Right, but it does look like we're still in the early stages of AI spend. If you look at the internet boom in the mid-90s to early 2000s, that was something that was a multi-year kind of investment cycle, and we're about 2.5 years into this one. So it looks like there's still a number of years to go potentially in this. So it seems like it's going to be a factor driving GDP for a while to come.
And it's interesting, going back to the point before, in the absence of earnings, and then we had 2 weeks where there was no earnings, there was no data that was coming out, and it was just, conjecture, headlines, is AI spend not exactly what it's going to be, or what's coming out of the administration was moving headlines. We were literally in a vacuum, for 2 weeks prior to the banks starting to report.
Trade headlines drove trading.
Yeah.
And they still kind of do right now.
Which is beneficial for Bookmap, though.
That's right.
Right? I mean, that's just going to continue to drive, the volume and volatility is great for a platform such as that.
But even if we were getting the durable goods, for example, and there was U.S.-China trade tension news, that would knock durable goods off the front page, right? So it's still something that would be the big
So
driver.
in the absence of data and bank earnings, I mean, the headlines, it was great for traders on your platform.
Yeah, I mean, there's a lot of opportunities in volatility for sure. I mean, one thing we're seeing that is rather, I've never seen it. I think it's rather unique, and I think it's a lot of retail, is the buying of dips and quick, kind of back to mean trades that happen very, very quickly. Whereas these would take a long time to work out, several years ago.
Yeah. It certainly does. So what would be the risk to, the thesis for next year? Is it predicated on the Fed either cutting, not cutting? I mean, it seems to be the market, geopolitics brushes it off, never tariff announcement, we're back to all-time highs.
Yeah, look, I think it's really easy to get distracted by all the stuff that's swirling around, right? It could be the administration, could be trade, could be tariffs. What matters over the long term, even the intermediate term for equities, is one thing, and that's earnings power. Right? So it's very hard to separate out all the noise and focus on that signal. So if you think about the setup we're in today, it's not that different, in my view, from where we were a year ago. So we roll the tape back to last year, right? You've got the tape trading 22 times forward, You've got the S&P at all-time high. You've got the economy in expansion, and here comes the first rate cut in September. So cutting rates in an expansion is exceedingly rare. It's happened 6 times in U.S. history. Cutting rates with the S&P at an all-time high is even more rare. They've done it 5 times in U.S. history, right? Both of those events occurred basically at the same time last year. They just occurred a couple weeks ago. History tells us that forward returns, when they're cutting rates in an expansion, which is rare, out 12 months, is plus about 17% on average. That's what we told our clients last year. And I got hate mail for that, right? But that's exactly how it worked out. But earnings have come through. The same setup is present right now. The only difference is when they cut, pause, cut, there's some questions, right? Why are they cutting again? It's labor market, probably now. Are there other things we should worry about? What if the economy is slower than we believe it is? What impact will that have in the earnings picture? So history tells us in the next, probably say by year end, we could get some more chop, we should get some more chop, and some more vol. But the forward look 1 year out, if that's your time horizon, is bullish.
Yeah.
So any weakness here in our view is buyable, and we think that's true around the world as well.
Yeah.
We have plenty of weakness this year.
I mean, chop doesn't mean
I
correction.
mean, just look what
April was good.
April was pretty
Yeah.
good, right? I mean, if you're comparing from April to year to date, you significantly outperform.
Yeah.
Right? But the S&P's up 15%, give or take, depending what happens today.
Right.
Maybe 16.
It's also based on your time horizon as
Yeah.
well. I mean, we're talking about generational buys. Okay, only 5 years ago you had the volatility in March and April during COVID, right? That was a generational buy. 5 years later, same thing.
What's the time horizon for most of your trades?
Same month.
Oh, daily.
Days,
Daily,
yeah.
daily, minute, hour.
It could be, yeah.
Yeah. Well, that's right. It always comes back to your parameters and
Yeah.
your timing and so
Right.
forth. All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.